A lot of people still lack the knowledge of what Islamic banking is really all about and how it differs from the standard banking systems most economies are using right now. There are countless misconceptions, misinformation, and fallacies about the dissimilarities of these two banking systems. Although Islamic commercial banks have many products similar to those offered by conventional banks, the two entities differ conceptually. One key difference is that conventional banks earn their money by charging interest and fees for services. It is profit-oriented, whereas Islamic banks earn their money through profit and loss sharing, trading, leasing, charging fees for services rendered, and using other Sharia contracts of exchange. Islamic banking is a banking system based on Islamic Sharia laws. Interest is completely prohibited in Islamic banking. It is asset-based financing in which trade of elements prohibited by Islam is not allowed. For example, you cannot take a loan for a wine shop. The basic purpose for establishing an Islamic bank is to promote and encourage Islamic principles. Islamic banks operate based on Islamic business law called Fiqh Muamalat for their basic transactions, and they also follow the financial laws and regulations of the countries in which they operate. Conventional banks likewise operate based on a country's financial laws and regulations, but they don't have contact with any religious body. Islamic scholars recognize that money has value, but with limitations. For example, money can't become more valuable simply because time is passing. However, the value of money can increase if it's invested in a project that itself is increasing in size, in success, and so on. In conventional banking, on the other hand, time value of money is the basis for charging interest on capital. When you deposit your paycheck in a conventional bank, your relationship with that bank is one of a creditor to a debtor. The bank has a responsibility to pay back your money with or without interest according to your account contract. Similarly, the roles reverse when the bank provides you with a loan. The relationship between a customer and an Islamic bank is completely different. Islamic banking has a multitude of trading structures and relations. For example, in a sale-based structure called Murabaha, the relationship is of a buyer and seller where earning, if any, comes from profit on the sale. In a rental-based structure called Ijara, the relationship is of a lessor and lessee where earning, if any, comes in the form of rent. In participation-based structures called Musharaka and Mudaraba, the relationship is that of a partnership where earning, if any, comes from profit sharing. In an agency-based structure called Wakala, the relationship is that of a principal and agent where earning, if any, comes from the fee. Investments in conventional commercial banks are based on guaranteed principal and earning a fixed amount of income. For example, say that a customer in a conventional bank deposits $10,000 in a 6-month term deposit. After 6 months, the bank has a liability to pay back the customer the principal plus the interest rate charged for 6 months. Even if the bank lost the money in an investment, the bank is still liable to pay back all the money due. In Islamic banking, the concept of investment is different. Although the customer deposits the money in order to earn extra income for her savings, her principal and returns aren't guaranteed. Suppose the Islamic bank loses money because of an unexpected business failure. In this case, the bank isn't liable to pay the money to its customer.